Sometimes the world of corporate restructuring seems like an episode of The Bachelor, what with all the theatrics of getting together and then very publicly breaking up when the partnership doesn't go as planned.
Warner Brothers Discovery announcing that they would be splitting into two different companies.
Changes are coming to Comcast, the media giant announcing it will spin off its cable TV channels, including MSNBC.
A deal finally between CBS and Viacom.
The media world has been particularly eager to break up and get back together again. CBS merged with Viacom in 1999, split in 2005, and came back together in 2019. Now, renamed Paramount Global, it's on its way to merging with Skydance. And the saga of Warner Brothers is almost as complicated.
It's kind of the trend, I think, and it's a cycle that seems to happen over and over again, and people don't really learn their lessons. You know, AOL Time Warner was not that much different than Time Warner, then versus how you look at Warner Discovery today and how they saw AOL.
Mark Patricof has spent a career as an investment banker and technology investor, specializing in media and entertainment deals. He now heads Patricof Company, working with athletes on their private investments.
Content's always going to be the most important thing. It's one continuous part of our industry that we know you can't really change radically. It's about talent and creativity, and it continues to hold value. And distribution will catch up and recreate itself, and new technologies will come, but the content's the constant.
With all the back and forth, when does it make sense to merge companies or break them up? And most importantly, when does it work for shareholders and when does it not?
We see every year add half a dozen to a dozen of these spin-offs and breakups of S&P 500 companies. The long history of that is that on average, they perform average. And they end up essentially receding to S&P 500 kinds of returns.
Greg Taxon is the managing member of Spotlight Advisors, consulting with corporate boards on activist shareholder campaigns, shareholder proposals, and capital structure debates.
There are outliers where splitting a business makes a lot of sense and can actually add value, both on a valuation perspective or a growth and opportunity perspective. But by and large, these things don't really create value. I think when you look at those indices, which basically buy the spun out entities and hold them, they tend to perform in line or under the S&P 500. So on average, these things don't really create value. There are times when a spin out or a sale can enable something different, but it's only really when the spin-out enables the two businesses to engage in some activity or attract people or investors that are different than the conglomerate, that these things really work.
The fact that a company has different business lines growing at different rates doesn't necessarily mean it needs to break itself up.
The fact is that the people who are running every division inside a business are pretty focused on that business. And it's unclear to me, at least, how separating it into either a separate public company or selling it creates more focus out of the people whose job it is to run that business. There are very complex businesses that perform incredibly well. Think Amazon, which has two very disparate businesses with Amazon Web Services and all of their retail, and even within retail, an advertising business, a physical business with Whole Foods, an online business. They got lots of things. They seem pretty focused on creating profit and growth and value. And it's unclear to me that separating any one of those, putting Whole Foods back out as a public company, would actually create more focus on the part of the people that run that business.
Yulia Snihor is a professor at the University of Navarra. Professor Snihor's study of spin-offs like Hewlett-Packard splitting from Hewlett-Packard Enterprises has led her to conclude that there is what she calls an ecosystem that can trigger corporate splits, one driven by the balance between complexity and complementarity.
A recent split of eBay from PayPal, where the digital payment, the fintech, started to evolve much faster than the second-hand marketplaces, where the eBay, the corporate parent, was competing. And so this difference in growth between the payment business model, where PayPal was looking at serving many different customers in addition to eBay at a much quicker pace with a much higher complexity, was very different from the marketplace more mature business model of eBay. And this divergence over time, this increasing difference between the two business models within the same company led to a split in this case. In the case of HP, where HP was originally selling computers, selling printers with a razor and blade business model, but it got also into software, particularly cloud, that started to grow at a very different pace in the 2010s compared to what was happening in the computer commoditizing ecosystem. We saw in the 1980s a lot of conglomerates building up, and in the last 20 years we see GE, Siemens, several companies in this wave of deconglomerization becoming much more focused, and investors looking for pure plays out there. In the last 10-20 years we see the separation between investors who want growth and investors who want value. And for a company that pursues both, that has a cash cow business that is delivering high dividends to investors and has another business that is growing a lot and needs a lot of investment, it's very hard to balance these two businesses. It's like riding a skateboard with one foot and riding a scooter or Formula One car on the other foot.
When it comes to the media sector, Patricof's experience is that these spin-offs and consolidations are all about the relationship between distribution and content.
It seems like these companies merge when they feel afraid of the distribution and they need to own the distribution. But then when a better distribution product or technology enters, they of course want to move to that. And that devalues the deal that they did when they merged. It's like cells coming together and cells separating and cells coming together again. Discovery with all these networks really is a legacy of the cable industry. So cable was distribution. Content filled distribution. And as soon as that distribution channel seemed less interesting, late 90s, you had AOL convincing the media giants that they were the future of distribution.
Cells may come together and separate regularly in the media sector, but when it comes to the particular area of sports entertainment, the get together, break up, and get back together trend doesn't apply.
98 of the 100 most watched television shows in the last 12 months for sports programming. I mean, appointment-based programming, live entertainment. It's the ultimate non-scripted, of course, because you don't know the outcome.
Why isn't there dilution? In a lot of entertainment, you get dilution over time as you add more and more. So far in sports, I can't see it.
Because I think the cream rises to the top. It's the same argument that people have with, well, women's sports ever generate significant amounts of value, and our ancillary sports, whether it's volleyball or men's or women's or the Olympics. But basically, there's so much value in these few assets that are out there, and they put so much money and energy into marketing them and maintaining them that the consumer only has so many hours in the day. And if you are a fanatic of football or basketball, there's enough to satiate you over the course of a 12-month calendar year that you're not really going to take a lot of time to put it to other sports.
Unlike the rest of the media world, sports investors are looking to get in rather than looking to get out of slower growing business lines.
So what does that mean for potential investors?
There are plenty of funds out there now that have raised a large amount of money to take minority stakes in NFL teams, MLB teams, NBA teams. I think it's an interesting idea. I think it helps professionalize the sport. It's certainly driven up the valuations. I'm just not sure how those limited investors, those small investors buying 3% of the Spurs or 5% of the Giants or 3% of the Dolphins, without a path to control, without a path to exit, without information rights, it's probably inevitable. I think the teams are going to have to be public entities at some point down the road. The valuations are getting too high. There won't be enough billionaires to buy them. It will require board of directors to run businesses of that scale. Community representation, minorities are not represented at the ownership level the way they should be. So you need racial diversity at the ownership level. There's a lot of things that are going to come into play now, as these are no longer family businesses run by patriarchs of family-run companies from the 50s.
Whether it's traditional media coming to terms with the changing world of distribution, or sports leagues and teams basking in the glow of ever-increasing interest, the one constant is the quality of content on offer.
Content is king. I think content is the one constant. There will be content. Consumers will want to experience original content, non-scripted content, sports content, what I do for a living. I think that that's something you could always count on as having value. And then the question is, how is that value achieved? How do you monetize that value?
And there is ultimately one source for that high-quality, compelling content, and one rule that has stood the test of time.
I worked for a man who ran Cap Cities ABC. He used to say, sooner or later, all the money goes to the talent. He was talking about shortstops back then.
I get it.
Is that true?
Sure. Look how much money the NFL quarterbacks are making. There's going to be a separate salary cap for quarterbacks for the next 2 or 3 years. I'll also give you a prediction, and hopefully we'll sit down again in 5 years. It's inconceivable to me to think that NFL quarterbacks and other prime positions, and then we'll go to the NBA and other sports, won't be owners of the teams they play on, and that'll be part of their contracts. Why would a chief technology officer at a Facebook or Google get equity in that business, but Joe Burrow doesn't get equity in the Cincinnati Bengals? So the talent is driving the value. They are part of the ecosystem that historically had been undervalued, while the owners and the media rights holders and the people building stadiums were creating all the wealth. But that pendulum has shifted. And that's part of our business model, but more importantly, it's appropriate because they're the ones who are doing the work.
In the end, it turns out that the company we need to keep isn't so much the corporate form or name, it's the company of outstanding talent. Talent that can create the content that is king.